Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm James Hughes, an investment manager based out of our London office, and this week I'm pleased to be joined by Richard Carter, our head of fixed interest research, and Will Howlett, our financials analyst. Morning to you both. Richard, perhaps I can start with you. Last week looked a bit quieter on the macro front, but perhaps you can kick us off and provide a roundup of the key events.
Yeah, that's right, James. It has been a little bit quieter. We're in this sort of lull period in between central bank meetings, and there hasn't been anything really to sort of change the needle, to change the dial. I mean, I guess the main thing last week was the US sort of potential US government shutdown that people perennially have to worry about, and last week was no different. But surprise, surprise, at the last minute they managed to come up with a deal to avoid shutting down, although it is quite a short-term deal, so potentially in 6 weeks' time we'll be doing exactly the same thing. But important to remember, this is different to the debt ceiling, which could potentially lead to default on US Treasuries. This would have been basically led to a lot of US government workers being furloughed temporarily, and also sort of no release of economic data, things like that. So fortunately that's been avoided, but as I say, it's very much a short-term deal. I mean, otherwise, I guess the main things going on, rising US bond yields, certainly not good for bond markets, but also certainly not very helpful for sort of US equities either. And basically what's going on is that inflation is becoming steadily a bit more benign, but certainly the US growth data's been pretty resilient, and there's no sign of this sort of long discussed recession arriving. So that's all led to a sort of expectation the Fed will be keeping rates higher for longer, and also the US government's borrowing quite a lot of money as well, which keeps the issuance levels for bond markets quite high. So yeah, been a difficult quarter for bond markets, but as I said, still think that central banks are pretty much close to the peak in rates.
Okay, thanks for that. Because on the other side, sort of since the end of July, we've seen actually UK gilt yields doing the opposite, and they've been falling quite steadily. And at the same time, sterling has also been weakening, in particular against the dollar. So could you run through sort of how gilt yields and sterling interact, and why there's been the change in direction recently?
Yeah, so UK gilt markets have outperformed US Treasuries. I mean, there's a couple of things going on. Here. I mean, firstly, I'd say that at the margin, the US economy looks a bit more resilient and in better health than the UK. Although, actually, some of the recent UK GDP numbers have been revised up a little bit. But the main thing is inflation. So, UK was seen as a bit of a laggard of inflation. It was still too high, taking a while to come down. But now actually does seem to be heading in the right direction. And investors' expectations for the Bank of England have changed. So we've gone from sort of thinking rates could get as high as 6% to actually, well, last meeting they decided not to raise rates at all. And when you get that sort of dynamic, it's quite good for government bonds, particularly at the sort of shorter end, which are very rate sensitive. Also not so good for the currency. Lots of different things drive currency, obviously, but interest rate differentials versus other markets, and I'm thinking about here, UK versus US. When you get this sort of fall in rate expectations in one country versus another, normally that's not so good for the currency. So that's why you've seen this sort of lower gilt yields, weaker sterling kind of dynamic.
Sure.
Dollar's also been strengthening against other currencies. I mean, the danger is, of course, if sterling, we import a lot of goods, food and energy, and if sterling keeps weakening, potentially that could be quite inflationary, and then the Bank of England may have to go from being on hold to raising rates. But as I say, for now, that more benign inflation backdrop has not been great for sterling.
Sure. Okay. Well, Will, perhaps it's a good time to bring you into the conversation, because obviously banks are very sensitive to these types of changes. So Can you explain sort of how this has been impacting the banks and how it might impact the banks going forward?
Yeah, higher interest rates generally thought of as good for banks, but as always, when it comes to banks, it's complicated. And clearly, the UK domestic banks not really been playing to that simple rule of thumb year to date. So shares have been a bit sluggish across the UK domestic banks. So if we think about net interest margins, banks have been enjoying much better spreads on their deposits. So they haven't passed on the full benefit of rate hikes to depositors. And so that's just a complete contrast to the zero interest rate environment as well, post the financial crisis. So they're enjoying much better spreads at the moment. But banks have been under pressure from regulators, politicians, the media to start offering better rates to depositors. So that tailwind, it does feel like it is coming to an end, and customers are also changing behavior as you would expect them to. So they're terming out deposits to get better rates by locking up their money for a year or so, relative to having things in instant access, for example, or they're looking at their current account and reducing any excess money they might have there and putting it in savings. So those add up to a bit of a drag going forward. And then on the asset side of the bank's balance sheets, mortgage margins have been under pressure. So there's been a big supply demand imbalance in terms of there's just fewer or less activity in terms of house purchases, and banks still competing on mortgages, so they're seeing lower margins, and those two really have netted out as a bit of a negative this year, with the earnings revisions coming down for the domestic banks as they've talked down net interest margins. I would still think, higher interest rate environments. So in the next rate cycle, when we get there, there's plenty of room now to cut interest rates without hitting the zero bound again. So I'd still see this as a better environment for the banks relative to the zero rate environment. I think, the Bank of England pausing on rates, as Richard mentioned, I think it does reduce some of the tail risks as well around the housing market and the UK economy. So, there are some positives there too. I think the big one for me is that profitability is a lot stronger for the UK banks, and it's also cleaner. So we don't have all the one-offs in terms of litigation or restructuring that you saw post the financial crisis. So it means their profitability is cleaner, so they can return more capital to shareholders. So buybacks continue, and decent dividends as well. So met with NatWest, for example, last week, and they talk about reducing their share count by 26% over the last 2.5 years. So that should boost their per share metrics going forward as well. So those are some of the themes that have been happening for the UK banks.
Okay, brilliant. It probably segues nicely into my next question as well, which is, as well as covering the banks, you also look at the wider financial sector. And actually, for some time you've been positive on the alternative asset managers. Can you explain or sort of run through why you remain positive, and why you feel that they can continue providing strong returns to shareholders?
Yeah, I like the alternative asset managers as they typically generate better investment performance for their clients. They enjoy they earn fees, pretty attractive fees from locked up funds, which means they don't have the risk of redemptions when we see market sell-offs that you might expect at traditional asset managers.
Sure.
The fees are also based on investments or commitments, so they're not marked to market like traditional asset managers. So you've just got much better visibility in terms of the fee earnings that they can generate. The shares in this space, the managers here, so the likes of Intermediate Capital, for example, partners in Switzerland, they've been performing better this year after a tough last year. I think a number of them are talking about some green shoots of activity. So I think the expectations that interest rates have peaked or are close to peaking, I think that does help to move buyers and sellers' expectations together. So there's just more deal activity. So, private equity managers want to be doing deals and selling their last asset, buying their next portfolio company. So it's just a better environment where there's more deal flow. Private equity certainly has seen a slowdown in fundraising, but private debt has been more resilient. So private debt strategies, typically floating rate lending, So they're offering higher returns with higher interest rates, and private debt is higher up the capital stack as well versus private equity. So lower risk, which I think institutions like at the moment, just given uncertainties on the economic outlook. So that has clearly been a strategy which has been in a lot of focus recently. So it's been featured in the the FT, lots of articles about private debt at the moment. So that has certainly remained resilient.
Thank you. That's great. Thank you. I think unfortunately that's all that we've got time for today. So I'd just like to thank you both for those great insights, and to all of you for listening. So to our listeners, if you enjoyed our discussion today, please review the show from wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, please tap the subscribe button. We will be back next Tuesday. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying markets overview, as well as subscribe to our weekly comments newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? If you do, please simply ask them via the weekly comments page on our website. We love to hear questions. And that's it for today. So thank you to Richard and Will for your time, and to all of you for listening. We will see you next time. Thank you.